Thank you very much for that great introduction, actually. I was going to talk a little bit about myself, but you've done that, so some of it might be redundant. I'm so impressed by the turnout. As an accountant, I'm an evaluator too, but as an accountant, we don't get this kind of interest in general. So thank you. All right, I'll kick things off. So my part of this discussion is really around how to build value in your business. So, doing that will help you attract capital, but really the purpose of this discussion today, as I'll set out a bit more in a minute, is how to build value by focusing on the value drivers in your business. I'm just going to talk a little bit about Crowe MacKay and what we do first. So we're a mid-sized accounting firm. We're based in Western and Northern Canada, primarily. You can see we've got 8 offices spread out in that region with over 400 staff and about 60 partners. And we're a full service firm, so we do assurance and taxation, but we also do all this other stuff like what I do in valuations and M&A, insolvency and other areas. So we see ourselves as able to provide services in any area for a company. In addition, we're part of something called the Crowe Global Network. So, within Canada, we're perhaps the 9th or 10th largest firm, but we're part of, kind of a giant accounting affiliation. That means we can service clients across borders and pretty much anywhere in the world. So this was the slide about me. I think you've heard all this already. I'll tell you a little bit about my background in respect of the CBV, in case some of you haven't come across that designation before. So CBV stands for Chartered Business Evaluator, and it's a kind of specialty designation that you do after you do your CPA or your CA, or when I article as a chartered accountant. Now we're called CPAs. The CBV designation, it's a 2 or 3 year designation, and what it really enables you to do is value privately owned assets and companies, so interests in companies and streams of income, as well as valuing public assets, as it says on the slide. CBVs focus on all kinds of different things. I mean, my practice area, you mentioned the M&A, and that's certainly something I do. I also do what's called expert testimony, so expert witness work arising from litigation. So that's in respect of shareholder disputes and things like that. Sometimes, commercial litigation, stuff of that nature. I work for public companies after they've acquired assets, helping them determine the value of those assets. And then in respect of M&A in particular, I'll value companies so that parties can come to terms over the value. If there's some, desire to reach a decision about the value mutually, I'll often do that for them. I do what's called buy-side due diligence. So if a company is buying another company or assets, they may want someone to kind of kick the tires on that, tell them what are the commercial risks and opportunities arising from that acquisition, and basically just give them advice about whether or not it's a good transaction. And then the last thing I do is help broker and negotiate transactions. So I can negotiate on your behalf to try and get better terms, if that's something that's required, right through the process. So here's my agenda for the talk. And as I said, really my purpose and my part of the talk is to, describe to you what makes a business more attractive to people that are considering buying it. What are the value drivers and what should you focus on improving the attractiveness of your business to outsiders? And, part of that might be because you want to sell your business, but it doesn't have to be for that purpose. I want to emphasize that. If you focus on the value drivers of your business and what makes it a better, work on making it a better business, obviously that has an inherent value to you. It ends up being a better business for you to run. That has the kind of side effect of making it more attractive to buyers, right? So my plan is to talk a little bit at the start about different approaches to valuing companies, but I'll very quickly focus on the one that's of interest to us here, which will be an income approach. I don't want this to be a theoretical talk at all, so I'm going to try and stay away from theory. Then I want to talk about what I see as three key value drivers in any business that basically they're the things that move the dial when you're doing an income-based valuation, and therefore that you want to think about as you run and operate your businesses. And I'll just think in closing about some other factors. So in terms of the theory part, when you're valuing a business, the first decision you always have is this a going concern, right? Is this a business that's going to stay in business? And if it's not, you perform a liquidation approach, which is an asset-based approach. And I'm not going to talk at all about the liquidation approach because I don't think that's why people are here. You're not thinking about putting your companies in a receivership, I hope. We're just going to talk about the going concern approaches. And once you decided your business is going to continue in operation for the foreseeable future, really as an evaluator, what you're looking at is it a holding company or an operating company? And again, I'm not going to spend a ton of time talking about holding companies because I don't think that's what you have. You have operating companies. But really, those are companies that they own real estate assets or maybe equipment that they're renting or marketable securities, things of that nature, right? And the value of those companies is always their asset value, right? It's the value of the underlying assets in the company. If you have an operating company, which again is kind of my underlying assumption here, if you have that operating company, it could be that an asset approach is the right approach. So if the returns on your cash flows are not sufficient to create value over and above those cash flows, in other words, continually reinvesting in your capital assets and so on, you're not generating any commercial goodwill, then an asset-based approach is probably appropriate. But again, there's not much point in focusing on that kind of business and that kind of valuation. What I want to focus on is, I guess, an approach where what you're thinking about is building commercial goodwill in your business, improving its value, right? And in terms of valuations, that's typically what we would call an income approach or a cash flow based approach. So you'll hear me say cash flow or income based. They're two sides of the same coin. All it means is future cash flows or future earnings of the business, right? I tend to use them interchangeably. So what I've got on this slide is a really simple income approach. And, you can see I've blanked out a whole bunch of assumptions. I've just zeroed them out because I don't want them to distract from the, kind of the basic concepts we're going to talk about today. So as Lawrence will tell you, any Canadian company is going to pay income tax. You have a limited amount of control over that. It's probably not, your primary focus in improving your business, reducing its profitability and taxes. So I'm ignoring it. Same with capital expenditures. So I've never valued a business that didn't have to continually reinvest in capital assets. They do so more or less. And, one of the things I'll talk about is businesses where you have to invest less in capital assets are typically better businesses in terms of creating commercial goodwill. But again, I'm not going to talk about sustaining CapEx. Businesses always have, well, sometimes they have debt. They always have redundant assets and liabilities. You can see that's a factor in a normal valuation, a full scale valuation. But again, I'm not going to talk about it. Instead, I'm going to talk about, the two main components of an income approach to start with. And, what does a valuator look at when they're valuing a business on this kind of approach? They look at what are the future cash flows of the business, first of all. They have to make some kind of decision about what the expectation is about those prospective cash flows. And then they have to make a decision about what the required rate of return is on those cash flows. So what rate of return would an investor want in order to invest in these cash flows, right? And just super quickly in terms of the cash flows, there's really two different ways you could do this. One is the approach I've got here, which I'm going to talk about in a lot of detail, the capitalized cash flow approach. It's where you're basically assuming that all the future cash flows of the business are in a particular range. So in this case, I'm saying $1 million. And the implicit assumption is that it's always going to be that in perpetuity, so forever, right? So that's not what's going to happen. Obviously, some years it might be 800,000, some years it might be 1.2. It's going to fluctuate. But the idea is on average, that's what it's going to be. The other kind of approach you can take is called a DCF, where you explicitly recognize the different amounts of cash flows going into the future. So if you know the cash flows are going to be significantly different next year than the year after, they're going to go up and down, and you can have a pretty good stab at figuring that out. You would set out those cash flows into the future, and you would discount them back to a present value. What we're doing with this methodology, the capitalized cash flow, instead, is we're taking a cash flow and we're capitalizing it. We're multiplying it by a multiple. We're dividing it by a cap rate. I'll talk a little bit more about multiples and cap rates in a minute. Well, in fact, I'll do so right now. A capitalization rate is basically just another word for the required return of an investor. And the thing to bear in mind when talking about capitalization rates is that the more risk that an investor sees in a set of cash flows, the higher the capitalization rate is going to be, right? They require a higher return to invest in those cash flows because they perceive them to be more risky, right? So if you think about, other investments you could make, like a Government of Canada bond, the return on that is super low. Like right now, it's 3% or something on a 10-year Government of Canada bond, maybe even a little lower still. So really a low return because there's no risk to the investor. They're going to get their cash flows, they're going to get their money. On the other end of the scale, if you have a venture capital, a venture capitalist investing in a pre-revenue startup company, they might require a capitalization rate of 50 to 70%. So when they're looking at future cash flows, they're heavily discounting those cash flows, right? And the point of the capitalization rate, obviously, is you're taking cash flows and you are discounting them, right? So you're rendering them into a present value. You're taking all these future cash flows and saying what they're worth today to that investor, what they should pay. And the higher the risk, again, the lower the present value because the higher the capitalization rate. And so just a quick word on multiples and cap rates. I put both here. So I have a 20% cap rate and a 5 times multiple. And the way these work is they're the inverse of each other, right? So if you have a 20% cap rate, 1 divided by 20%, that's your 5 times multiple. And vice versa, the 1 divided by 5 times is your 20% cap rate. They're just different ways of expressing the same thing. You're either multiplying a cash flow by a multiple or you're dividing it by a cap rate. In either case, you're getting that present value of future cash flows, right? The risk-adjusted returns that an investor expects on those cash flows. So before I leave this slide, there's one further thing. So, as you can tell, I'm going to be digging into what makes a good cap rate. Like, why would you end up with a good cap rate? And what do investors look for in earnings or cash flows? What makes those attractive to an investor? What are the characteristics of those that are attractive? The last thing to talk about here is goodwill. So I mentioned it briefly before. And at the bottom of this slide, you can see that I've done a little, basically I've taken the present value of the future cash flows, so the cash flow value, or we call it enterprise value. And from that, I've deducted the tangible assets of the business. So this is all the assets in this business you need to generate the $1 million of cash flow to create the $5 million of present value, right? And to evaluate, when you deduct from the cash flow value, when you deduct the tangible value of the assets, you're left with goodwill. So, in a very obvious way, the higher your goodwill, or the higher your tangible assets, all things being equal, the lower your goodwill is going to be. So lots of even evaluators don't focus very much on the balance sheet when they're valuing companies, but it's super important. And I'll talk about it a little bit more further on. One of the hallmarks of an attractive business is that it's well run in terms of it's got basically as little working capital in it as possible, while still working optimally, right? While still operating well. So I'll start by talking about cash flows because they're easier to speak about. It's harder to tell you how to get more cash flows in your business, but I'll talk to you a little bit about, when you're a buyer, what looks attractive, or when you're someone offering financing, what looks attractive in a business. And, an investor will always look at historical cash flows in a business. They'll always look at usually the last 5 years. They might look at more if it's a cyclical business and a cycle is typically 10 years, they might look at 10 years of cash flows. And the idea of that is really that historical cash flows are indicative of future value. So you don't look at them for your own sake. You're using them to project what's going to happen in the future. So there's like 7 rules of valuations, and one of the rules is value is always prospective. So the past only matters insofar as it tells you about the future cash flows of this business. And the example I always give to people who don't understand this first time is the made up example of a gold mine where it's been spitting out $1 million of EBITDA for 50 years or something, but it's running out of gold. What's it going to be worth in the future? Well, if there's no gold, it's not worth anything. There's no future cash flows, no matter how consistent they were at $1 million in the past. So, what does an investor want to see when they're looking at these historical cash flows? The first thing is they're going to look at the most recent year with the most interest. And it's for the same reason as I just gave. It's probably the best indication of what your business is going to do. So you obviously aren't, looking to sell your business off its worst ever year. You're trying to see you're trying to do it off a good year, obviously, right? The second thing that is attractive in the cash flows of a business to a buyer is consistency of earnings or cash flows. So I value businesses all the time that have significant fluctuations, and sometimes it's just the nature of the industry. Like construction is like this. There's ups and downs all the time. And what that does in the mind of an investor is it creates risk, right? There's a perception that you don't know what your cash flows are going to be, and you might have a financing gap or whatever. They don't like that. And what it makes them do is add to that capitalization rate. They perceive it as more risky, so they have a higher capitalization rate than they otherwise would, and therefore lower enterprise value, lower present value of cash flows. So they look for consistency, but not stagnation. So if you have the same cash flows every year, that's not necessarily a good trade either. Obviously, one of the things you're looking for in a business is growth. And the way that plays out in multiples is kind of obvious. The more growth you have, the higher the multiple. And the reason for that is that you kind of can grow into your multiple, right? So if you have a 6x multiple, but you're growing at 20% a year, you'll soon grow into that multiple, and it's no longer a 6x multiple. It's actually a 4x multiple. And so an investor will look at it on that basis. They'll, again, think about the prospective cash flows of the business. And then lastly, size does matter. So, in respect of businesses, certainly in the Lower Mainland, but any business I've ever valued, there's a kind of staggering of multiples that occurs at different levels of cash flows. So if you're under a $2 million EBITDA, you're probably going to be offered a range of multiples that's lower than if you're at $2 to $5 million, right? Or 5 to 10 and 10 and above. At each of these kind of little imaginary hurdles, if you will, you suddenly are attracting a greater market. Like the reason you're getting higher multiples is you're attracting a larger universe of buyers, right? So there's more people that are going to be interested in your company. They might come from other places, like outside of province, outside of the country. They often, because they're larger, have deeper pockets, right? So they're going to have access to financing. They're going to be able to pay that higher multiple. In addition, they're going to be able to do things like bolt you on to other acquisitions they have. So like private equity, right? For example, what they'll do is they'll buy, 3, 4, 5, many more businesses in the same industry, and they'll push them together, right? They'll get consolidation synergies, right? Because they can eliminate back office and create efficiencies in the operations and so on. And it generates additional value. So size is an important factor. And at the bottom of the slide, I have some comments about, really, I don't have any magic bullet as to how to increase your cash flows. I have more ideas about what to do with cap rates. But it's as simple as you're trying, usually on the revenue side to create additional services or products. And on the cost side, you're trying to create efficiencies by basically managing your margins better, right? Gross margin and net margin. And I mentioned consolidation, which is not unimportant. We're seeing it in this industry to a degree where, it's very cost effective to do. So capitalization rates, what makes for an attractive capitalization rate, or how do you bring that capitalization rate down? If there's nothing else you get out of this talk, this first comment I make it again and again and again to business owners because it's really important. The most important thing you can do is eliminate the business owner from the operations as much as possible. If you're trying to create value in a business, or you're trying to make it an attractive business, which isn't, necessarily an attractive thing for the owner to think about, but there's a good reason. If you think about a business where the owner has all the relationships, right? Say all the customer relationships, from a value perspective, if that owner gets hit by a bus, that's the end of the business. An investor won't look at it quite in those terms, but they look at it in terms that owner is going to have to transfer all those relationships over to you, to the new buyer. And the question is, how able are they going to be able to do that? How do you transfer personal relationships, right? So it's what we call personal goodwill. There's goodwill, but there's different kinds of goodwill. So personal goodwill is goodwill that's not easy to transfer. It inheres in a particular individual in the business, usually the owner. Commercial goodwill, by contrast, is stuff that you can buy, right? So your objective, if you're an owner and you're thinking about selling and you want to get a better price, is always to build management depth, right? You want to create a team in there that is doing as much as possible of your job, right? So that you're withdrawing from the operations, you're transferring relationships to your marketing and sales people. You're looking at extracting yourself as much as possible, and your family too, if you can do it. So it's really reducing dependence, right, is the first thing, because that dependence creates risk, which again makes the cap rate higher and the multiple lower and the value lower. So, there's all kinds of other dependence. So when I'm doing due diligence for companies, the first thing I always look at is customer concentration. And it's obvious, right? If a business has 1,000 customers all with the same revenue, that's a better business model than a company with 5 customers and one of them is 80% of the revenue, for similar reasons as to the owner, right? If you lose that customer, your company's kind of hooped, right? So you want diversity and lack of concentration, and same with suppliers, right? You de-risk your company when you have more than one supplier, because if you're dependent on a supplier and that supplier goes out of business or chooses not to continue supplying you, obviously you've got a problem. You might not have continuity of supply, you might have more costly supply, you might just have temporary problems, but it's a problem. So you want to diversify suppliers as well, and so on with pretty much everything in your business, right? You're always trying to create diversity. So is it better to have a bunch of products than one product? Of course it is, right? And same with distribution channels. You want to find more ways to market, not less. And you want, to sell into as many markets as you can. If you can sell into other provinces, like why wouldn't you do that, or other countries, right? Other markets are in different ways. So you want to create diversification and reduce dependence. So other key factors in terms of bringing down cap rates and creating value, it's barriers to entry. And really, what are barriers to entry? They're things that make it harder for people to compete with you, right? They're things that differentiate you and make it harder for your competitors to compete with you. And in this industry, obviously, a key thing is brand, right? So you spent time and money building a brand, and if somebody else hasn't done that, they're going to do it. It's giving you a competitive advantage, right? Because people have a favorable impression of your product. They have good memories of it. They're going to keep using your product, right? So the presence of a brand over like some generic drink is obviously important. And so are the things that support the brand. So, I've got intellectual property, and whether or not that's, some kind of patented property, if you have things like recipes or formulations, those are important. A buyer will be interested in buying that. It's a product, if you will. It's an intangible asset of the business. What else have I got here? Agreements and contracts. So it's astonishing how many businesses you go to sell and they have handshake deals, right? And again, it's just risk from a buyer's perspective. So I'm working with someone right now, and they did not have a contract on their premises, right? They didn't have a lease agreement in place. A buyer is going to have to go put that in place, of course, and right off the bat, it's going to lower their respect for you as a management if you don't have things like that in place. Same with contracts. That the more things you have on a contractual basis, the better as far as a buyer is concerned. And obviously, they're a source of value. So if you have a customer contract, that's going to be more valuable than a customer relationship, right? It's something that is a legal document. So agreements and contracts are inherently favorable, and again, de-risk your business, right? Create more value. And I've got on here track record and history in terms of cash flows. It just shows you the interdependence of cap rates and cash flows, right? If you have those, what does it do? It brings down your cap rate, increases your multiple and your value. And the balance sheet I'm going to talk about right now. So, again, this is kind of forgotten part of building value in your business, but the investment in tangible assets is a not unimportant consideration. And so first of all, what do I mean by tangible assets? I mean net working capital. So receivables, it's typically receivables plus inventories, maybe plus prepaids, less accounts payable, right? That's your net working capital. So your investment in the working capital in the business, which, I would think would primarily be inventory, right? In this room. So, I talked about why it's important that your tangible assets not be overly large in comparison to your present value of cash flows, right? The difference is goodwill. The higher your balance sheet, bigger your balance sheet, the less your goodwill. So, it's obvious from a mechanical point of view, but, why is that the case? It's probably worth digging into a little bit. And, it's really to do with return on equity. So this formula I have here in the top with the cash flows and the bottom with the net assets, the denominator, right? So when divided into the other, the higher your cash flows, obviously all things being equal, the greater your return, and the lower your tangible assets, the greater your return. And the greater your return, the more attractive the investment, which is obvious from an investment perspective. So, if you tell an owner that you can make an investment of $100,000 and get $10,000 return, or you can make an investment of $200,000 and get that $10,000 return, they can always see that the first investment is more attractive. But it's quite surprising, when you talk to business owners or management, how often they don't consider their investment in working capital to be a similar investment, but it is, right? At some point, to have that investment in working capital and tangible assets, you put that money in the business, like either as shareholder loans or an equity investment, or probably what's more likely is you haven't taken out returns that you could otherwise take out if you managed your working capital better, right? So there's what we're talking about is excess net working capital or excess capital assets, and it's really more net working capital. So, that's this point. There's the real cost of higher working capital, right? On your business. Basically there's a return that you would have been able to take out. You haven't been able to take out because you've got this overly high return. And, one further comment, when I deal with people selling their businesses and when I'm on the buying side, there's always a reckoning after you figured out the valuation, where you figure out how much working capital has to be left in that business when you go to sell it. And the most typical way of deciding what the net working capital is going to be left behind is you figure out what was the average for the last 12 months or the last 2 years, right? What was the average debt-free, cash-free net working capital of this business? And that's how much you leave behind. So if you think about it, if you're, you're operating a business and, someone offers you an enterprise value of 10 million, we'll give you 10 million bucks. They go and look at the working capital and you've used 2 million over the last 2 years just because you haven't been bothered to be on the tools when it comes to working capital, but you could have done it with $1 million. Literally at the end of that transaction, you're going to leave $1 million behind that you should not have done, right? So very often we work with our clients a year or two out from selling their businesses on exactly this, right? Managing their working capital and tracking it so that they can sell for what amounts to a higher value, right? The last comment I want to make about working capital, though, is that you can overdo this, right? So, if you have too little inventory, obviously, it's going to interfere in your operations, right? You're not going to be able to supply the product on a timely basis to your customers, and that's not a desirable state of affairs. And same with things like, of course, it would be nice if our suppliers financed our businesses, but after a while, they get fed up with that. They see you as a deadbeat customer, and it can be more costly. They can charge you more. You may face delays and things like that in getting product. So, those are the kind of three main value drivers in evaluation in terms of mechanics, right? Cash flows, cap rates, and the quality of your balance sheet, call it. The last thing I wanted to talk about was just other considerations, and there's millions of things we could talk about, but from the point of view of a buyer, like the top of the list is going to be information and processes in your businesses. So, one thing I often tell people a few years out from selling their business is you really want to focus on your information. And if most Canadian business owners get notice to reader financial statements because that's all we need to do, right? If you do that, I would upgrade it. I would get review financial statements in preparation for that sale, or even audits, right? And it's not so much because the person buying the company is going to have a higher level of assurance from getting that audit instead of the NTR. But although that's a good thing, right? It's not unimportant to them to see a higher level of financial assurance, but it's really what it makes you do. It makes you focus on your financial reporting. You have to have good financial reporting to support that higher level, right, of assurance. So to have that audit, you're going to have monthly financial reporting, and it's going to have to be pretty strong, right? And that's an inherently good thing for a business, is to have good financial reporting. I've valued probably over 1,000 businesses now over the last 20 years. And to an investor or evaluator, look, you can tell so quickly whether a business is well run. It is almost always linked into how good their financial systems are and their financial reporting. It makes such a difference. If you're a buyer, there's this added benefit that if you happen to want to know stuff about this business and they've figured out what their key performance indicators are and they're tracking them and they've been doing that for 3 years or something, you can find that out right away, right? And so again, it's a de-risking of that business as an investment. They can get to the heart of the matters very quickly. So it adds value to the buyer. And I guess my last 2 points, it's, think about this well in advance. So, like I say, I think you want to do some of this stuff just because it helps your business. But if you're selling, try to do it 2 or 3 years in advance. And the other, I mentioned that we sometimes help business owners control their working capital and figure out how to manage that better. The other thing is this: we do come into businesses 2 or 3 years out for our clients, and we'll tell them, kind of a longer version of this talk, what they should be doing to specifically make their business a better business. And I mentioned we do buy-side due diligence. So that's when we're acting for buyers, buying a business, kicking the tires. We can do the same thing if you're selling, right? And the output, the deliverable, is a document setting out, the quality of earnings of this business and discussing the kind of key opportunities and strengths of that business, right? And the idea is you present that to buyers and they can rely on it, right? And so it helps you market your business. So that's my part of the talk. Just to recap, 3 key things, right? Cash flows, you want growing and consistent cash flows of a certain size. In terms of cap rates, you want to reduce risk, de-risk your business in general by doing things like creating competitive advantages in your marketplace, improving IP and things like that. Reducing dependence, and especially on the owner of that, again, is like the really key thing. And managing your balance sheet better. All of those things will drive value in your business and make it more attractive to a buyer. And of course, my last spiel, systems and processes. Thank you. I was going to say, should we hold on to the end for questions and just do it all as one round? Does that make sense? Yeah.
Thank you, Dan. I have the remote. Thank you. Great, thank you. Oh, hi, everyone. Just for the interest time, I'll try to speed up a bit here. So my name is Lawrence Tam. I'm one of the tax partners from Vancouver office at Crowe MacKay. I work very closely with Daniel. So today, I'm going to go over some tax consideration when you actually want to sell your business. I promise it won't be technical. I know that you guys have lunch not long ago and have been drinking beer. So if you drink coffee, maybe I go a bit more technical. But anyways, I'm going to skip this profile slide here. If you want to get to know me or give me a chance to get to know you, maybe we could meet up after seminar, have a pint of beer. Okay. So really quick, for sales of business, generally speaking, regardless whether you're planning to retire in the next few years, whether you're planning to maybe pass a business to someone in your family, or you simply just want to sell today or in the near future. Not only that, you might also want to talk to my colleague Daniel to figure out how much your business is worth today. You want to find out the value, but you might also want to consider any tax implications surrounding on different choice on how to sell your business. So, generally speaking, in Canada, when you want to sell an incorporated business, the two typical types of options will be selling the shares of company or selling the business asset of a company. Okay. However, there's actually also one additional option or hidden option. It's called a hybrid sales. The hybrid sale, by the name of it, is basically just combining the components or the elements of selling your shares and selling your business assets together to come up to an optimal result for the seller, or perhaps bridging the conflict of interest between the buyer and the seller. So the first option we look at is share sales. So pretty straightforward. Share sale is basically just the business owner will sell the share of the company to the purchaser for a set price. And anytime when we have share sales, generally speaking, you will likely to trigger a capital gain from the sales. And the capital gain is generally calculated as the follow, which is the gross sales proceeds minus the adjusted cost base of the shares. So, and the adjusted cost base of shares could be pretty nominal. For example, if you set up a company on day one, when you incorporate a company to run your business, you might just subscribe for the company shares at a nominal value. So the adjusted cost base could be pretty nominal, unless you actually purchase the business from someone else and purchase their shares. Then of course your cost base of the shares could be at a higher amount. You may also deduct any expense or outlays related to the sales, such as any professional fees you might have to pay to your lawyers or accountants, or any commission that you might have to pay in order to trigger that sales. So based on this formula, you will then, generally speaking, under sales of the shares, you would likely to come up to a capital gain. From the seller's perspective, it is actually a sales of shares is actually a more favorable choice or option because not only that, only half of the capital gain is taxable, okay, meaning 50% of that you don't have to pay tax. Only 50% of that will be subject to income tax. If the shares that are being sold also qualify as a qualified small business corporation shares, in short, QSBC shares, then there's something called a lifetime capital gain exemption that the shareholder could claim to shelter part of all of the capital gain. So therefore, the capital gain may be tax-free. However, of course, there's a limit of how much this lifetime capital exemption amount is. As of today, in 2022, the amount is about $913,000. This amount would go up by a few $1,000s every year. It got indexed up to adjust for inflation. So, for example, I would expect that the lifetime capital exemption amount will be maybe around like $950,000, $20,000 by 2023 or 2024. Okay, and not everyone or every entity could claim this lifetime capital exemption. The person who could claim this lifetime capital exemption must be a individual Canadian resident. Okay, so keep that in mind. And so to qualify for the lifetime capital exemption, as I mentioned earlier, the share itself must be a QSBC shares, qualified small business corporation shares. And in order to meet in order to have these shares be considered as QSBC shares, there's some condition and criteria that your company shares must have to meet. The first is that your company must be considered as Canadian-controlled private corporation. By definition, generally speaking, a Canadian-controlled private corporation means that more than 50% of the voting shares of the company are being held by Canadian residents. Okay, in rare cases, sometimes that the majority of the voting shares are being held by non-Canadian residents, and that company may still be considered as a Canadian-controlled private corporation. If, for example, the minority Canadian shareholders could actually make the decision for the operational side of the business, then this company itself might still be considered as a Canadian-controlled private corporation. At the time of sales, at least 90% of the fair market value of the corporation asset must be used to earn active business income, being carried on more than 50% in Canada. And also, in the past 24 months, immediately prior to the sales, the share itself must not be held by anyone else except the owner or someone who is related to the owner. And lastly, in the past 24 months prior to the sales, at least 50% or more of the fair market value of the corporate assets must have been employed to use or to be used to carry on a business in Canada to earn active business income. So if you look at all these criteria here, you see that in order to enable your company shares to be a QSBC shares, it's actually quite time sensitive. Okay, meaning that if you plan to retire in the next few years, it might be, or to sell your business in the next few years, it might be time to look at whether your company shares would qualify for QSB shares today to make sure that you're not offside. If you're offside at the time of sales, you may not be able to enjoy the lifetime capital exemption to tax shelter up to approximately $900,000 of capital gain. So what if you see I'm actually offside now because, for example, my company has been doing well. There's some excess amount of cash building up on the books, on the balance sheet, and I actually turn into those cash into an investment portfolio. I under the company name, I actually open up an investment account, invest in marketable securities, mutual fund, and term deposits. That means that type of asset is not asset used to earn active business income. Well, that's one way to purify your asset. This purification strategy is to enable more than 90% of your asset of the fair market value of the asset will be considered being used to earn active business income. Now, one way to utilize this purification approach is to sell your passive asset. So after you sell your passive asset, you will turn your passive assets into liquid cash. Then what can you do? You can actually pay out a salary or dividend to the shareholders. So therefore, there will be less cash, idle cash sitting around in the company doing nothing. However, you may say, but if the shareholder receive more income from the company, the shareholder themselves have to pay more personal tax. That's true. So this strategy is actually more effective if, for example, the shareholder has some unused RRSP contribution room. Then after the shareholder receive more income from the company, the shareholder could actually turn around and purchase more RSP. Okay, so therefore, this income inclusion will also get a offsetting deduction on that shareholder personal income tax return, and therefore achieve some income tax deferral. Another way to achieve purification is to look at the balance sheet and see whether the company has any credit balance or shareholder loan. If the company actually owe the shareholder or related companies some loan, then maybe again you could consider using the surplus cash to pay down or pay off this loan to the shareholder or to the related corporation. Okay, and again, if you have surplus cash, you could also use this cash to purchase more asset that can be used to help the company to earn active business income, such as buying more furniture, buying another commercial property that can be used to run your operating business. So all these options are ways to purify your assets. So therefore, by the time when you sell your shares, the shares will be considered as QSBC shares to enable you to claim the lifetime capital exemption. Another strategy to enable you to benefit from the lifetime capital exemption is what we call the crystallization strategies. So what does that actually really mean? What it means is that you could actually internally create a capital gain for yourself. So one way to do this is, okay, before I actually sell my company shares to anyone else, right? How can I realize a capital gain? I know that from day one to now, the value of my company is worth $900,000. Okay, I really want to sell the shares of my company to someone, to the purchaser. But oftentimes, purchasers are only interested in buying the assets of my company. They are not interested in buying the shares. So what you could do is you could actually do something called the crystallization strategies. For example, you could transfer your company shares to a holding company. And at the time of transfer these shares to the holding company, you have two choices. You could actually choose to transfer at cost, meaning that on a tax deferral basis, you transfer your shares of your operating company to the holding company at cost, triggering no capital gain, okay? Tax efficient. Or you could actually choose to transfer the share at a value higher than the cost, such as $900,000, okay, or at a fair market value. If you do that, that means you will internally trigger a capital gain by yourself. And if those shares of a company qualify as a QSCP shares, and you do have unused lifetime capital exemption, that means that you can ultimately tax shelter the $900,000 internally generated capital gain by yourself. Okay, and thereafter, if someone else is actually interested in buying your business assets after this crystallization, you could then choose to sell the business asset to them, but on the same time, you would be able to still benefit from the lifetime capital exemption. The other way is another way to do the crystallization strategy is to sell the shares back to your company. Okay, sell the share back to the company, and in exchange of a new class of shares. This is also this really similar kind of approach, because when you actually exchange the shares for the same corporation, you could also have option to exchange the share at cost or exchange the shares at a value higher than cost. By doing that, you could also create your own capital gain and claim the lifetime capital exemption on the share that being exchanged. Now, the last option, which is not least, is to multiply your lifetime capital exemption using a family trust. So as I mentioned earlier, only Canadian individual residents can claim a lifetime capital exemption to shelter the capital gain. A trust itself, like a family trust itself, cannot claim lifetime capital exemption. However, if you actually could do some restructuring of the shareholding of your company by having a family trust being the shareholder of your company, and any future capital gain realized by selling the shares will pass through the family trust to the family trust individual beneficiaries. And those individual beneficiaries, if they're Canadian resident beneficiary, each one of them will be able to claim the lifetime capital exemption. So this is actually a very powerful tool. Instead of having you yourself being the sole shareholder of your OpCo or operating company, you could only claim up to $900,000 lifetime capital exemption. Now you could actually multiply by 3 or 4, depending on the number of beneficiary being set under the family trust. So ultimately, you could actually tax shelter capital gain up to $900,000, 1.8, 2.7, or even like 3.6 mil of capital gain when you sell the shares, assuming the share would qualify as QSP's share at the time of sales. Maybe I will skip the hybrid sales, but just quickly talk about the asset sales. So by the name of asset sales, that's the other option to sell your business. This is actually a more preferable way for the buyer, because the buyer could choose and pick the assets they want to buy. They don't have to buy the share of the company, because by buying the share of the company, not only that they would take over the asset of the company, they will also take over the liability of the company. They need to take care of the payroll liability. They need to take over the income tax liability. So not all buyers are interested in buying the liabilities of the company. So therefore, they would choose to just purchase the assets of the company. However, if you do choose to buy only the asset of the company, be aware of that. Oftentimes, there will be sales tax involved, or maybe there will be public transfer tax involved if you're buying, let's say, real estate commercial property from the seller. The seller generally they don't really like this idea of selling assets, because 1, they cannot claim the lifetime capital exemption, and 2, they pay 2 level taxes. 1 level of tax is paid at a corporation level. The corporation that holds the asset, sold the asset, pay the corporate tax on the capital gain. And when the after tax money flowing out from the corporation to the shareholders or to owners, the shareholder themselves will also pay another level of tax at their personal marginal tax bracket. So there's a two-layer tax they need to face. So this is not really a favorable option for the seller. Now, as you can see, there's a conflict of interest between the buyer and the seller. The buyer wants to buy assets, the seller wants to sell shares. So therefore, it is quite important to make sure the buyer and seller negotiate the purchase price allocation. Okay, how much of the total purchase price will be allocated to, let's say, inventory or depreciable asset, and how much will be allocated to non-depreciable assets? Because any purchase price get allocated to non-depreciable assets, the sales of that non-depreciable asset will be considered a capital gain, and capital gain itself, again, 50% of that will be taxable. The other 50% non-taxable portion may possibly be for the company to pay out a tax-free dividend to the shareholders. So make sure that the purchase price agreement is actually carefully considered. As I said, I will really quickly skip this hybrid sale. But again, basically, hybrid sale is the combination of selling both the shares and the assets at the same time or in the chronological sequence. But however, for hybrid sales, it requires a lot of tax planning. It requires corporate reorganization or share restructuring. That being said, for hybrid sales transaction, it will actually involve more professional fees. It's more costly. So it really depends. It might still be worth it. If you've seen that a lot of tax saving, it might still be worth it to go ahead with a more complex tax planning to achieve a hybrid sales. So that would just kind of wrap up my presentation on sales of business.